Okay, the final part of this video, I want to cover our 4 financial statements. And remember, all of our financial statements help us measure and communicate a company's financial position. So the income statement helps you measure your profitability. It does not measure cash. It measures if your revenue was more or less than your expenses. So revenues are defined as the amount you charge your customer for your goods or your services. Expenses are the costs incurred to provide those goods or services. So if I charge a customer $10 for a t-shirt that they purchased from me, I would record $10 of revenue. But I paid $6 for that t-shirt. So that would be my cost of my goods. That would be an expense I need to record. Therefore, in theory, I would have $4 of profit, or what we call net income. But that does not measure how much cash I have at this moment. So please do not exchange those terms. They're not synonyms, cash and revenue, nor is expense and cash. So income just measures if you've charged your customer more than it costs you to provide that good or service. If the expenses are greater than the revenue, if I had a negative number here, we would refer to it as a net loss. The next financial statement we want to talk about is called your Statement of Stockholders' Equity. Remember, equity measures the ownership of the company, and it's external ownership in our common stock account and internal ownership in the retained earnings. So how does the internal ownership or worth of the company grow? Each month, quarter, or year that they're profitable, it gets added to the retained earnings account. It's kind of like a savings account. So you need to do the net income first, calculate that, or your net loss for the time frame. It could be for a month, a quarter, or a year. And then that amount gets added to, if it's a positive value, your retained earnings account. So you have to create your income statement first to decide if the company has been profitable for that period of time. And then you would add that to the retained earnings account. It's kind of like you have a giant present for Christmas, and then you open it up, and inside there's another present, and then inside that there's another present. So you have a giant box of equity. Inside that box you have a retained earnings box and a common stock box, but inside retained earnings you would find also the net income, which remember had the box of revenue and expenses. And from the net income we would pay out any dividends. That is a payment to our shareholders, their piece of the profit, and then we'll have our new ending retained earnings balance. So that ending retained earnings balance will go on to the next statement. That's why the order of these statements is really important. Common stock, the only thing that typically happens there is we would issue more stock possibly. That would get added on this statement. And then again, we're going to use this new ending balance of common stock on our next financial statement. Okay, the third financial statement we want to cover is the balance sheet. This one you kind of already have memorized if you know the accounting equation, because your accounting equation lists all your assets, your liabilities, plus your equity accounts. It has to balance, therefore the title balance sheet will kind of trigger you for what you're supposed to list. Remember, all your assets are things of value, and then where'd you get them? Who can claim them? So then you'd list your liabilities on the other side. You'd have a total of your assets. And these two ending balances from the previous statement, from the Statement of Stockholders' Equity, come in for your new ending retained earnings. Make sure you pull the ending retained earnings from the Statement of Stockholders' Equity and the ending common stock balance. Otherwise, the balance sheet will not balance. So all of your financial statements are for a period of time, except the balance sheet. The balance sheet is for a point in time, referred to kind of like a snapshot versus a video. The point in time can be any date, but typically the other financial statements, not the balance sheet, the income statement, the Statement of Stockholders' Equity, and the Statement of Cash Flows, those three are for typically a month, quarter, or a year. You'll see it titled at the top. This is for year ended 2016, or for the first quarter ended in 2016. And again, all these financial statements are tied together, so make sure you keep them in the correct order when creating them. There's one more statement I'm going to talk about briefly, and it's called the Statement of Cash Flows. So The final financial statement we want to cover is the statement of cash flows. Your balance sheet would list your ending cash balance. So the total of this statement needs to match your ending cash balance. It'll be broken down into 3 sections: operating, investing, and financing. Operating lists all the cash inflows and outflows for revenues and expenses. If you sell your product, remember that's a revenue. If you provide a service, that's a revenue. If you pay a utility bill, that's an expense. Anything you incur to operate your business. One item often overlooked in this category is interest. Interest is always a part of operating activities because as we get into it in the next chapter and further on, you'll find interest is recorded as interest expense or interest revenue, depending upon if you've earned it or if you have to pay it. The next category would be investing. Again, cash inflows and outflows. It's just taking an analysis of your cash account, since that is a very important account. The investing category refers to all our long-term assets, purchases or sale of things like land, equipment. If you have a building, any intangible assets that you buy or sell go into this category. Even notes receivable, that is an investment because you're going to get a return on that. Anything you're going to get a return on is in the investing section. And the final section is the financing section. That covers your funding. How did you got an F here and an F here. You can remember those 2 F words. So how did you fund your business? Did you issue common stock? That would be one thing that goes in this category. Did you borrow? So did you take out a loan, often denoted as a notes payable, different from a notes receivable. A long-term loan is notes payable. And dividends, those also go into this category. Dividends, when you pay them. Now, if you were to receive them, that would be a type of income, go into operating, but our dividends that we pay go into the financing category. So you would have all your cash broken out into one of these 3 categories. That change in cash will be added to your beginning cash flow to balance with the ending cash flow. That's all I wanted to cover from chapter 1. I will work out a creation of the financial statements in the end part of this video.